One of the absolute biggest pieces of SoFi news dropped this week, and I don't think anybody is covering it. Analysts are not really talking about it because it didn't come from institutions, it didn't come from a press release, it came from a retail investor. One that has been on the SoFi podcast in the past, Chris Hoeger, who recently had the chance to interview SoFi's Chief Financial Officer, Chris Lapointe, to clear up one of the biggest pieces of confusion that SoFi bears and bulls have around the company. And this is, of course, SoFi's stock-based compensation. This has been a gigantic bear point, one of the biggest negative arguments that I hear consistently around SoFi stock. And the findings of this interview are absolutely massive to deconstructing that and shedding some light on SBC as an issue. Of course, earlier this week, there was also news around Anthony Noto confirming a 3.75 APY for self-employed individuals on their savings account. But this article was by far the largest piece of SoFi news because it's the most impactful to the entire thesis around stock-based compensation as one of the biggest arguments that bears consistently use to dissuade people from investing in SoFi. And of course, if you're a consistent viewer of the channel, you know that I cover SoFi news, commentary, and analysis. And so I wanted to tackle this, more importantly, to spread awareness around it because this was a retail investor conducting an interview with a chief financial officer, which is a huge win for all the retail investors out there, number one. And number two, a lot of analysts, this has gone under the radar because it was a retail investor and it wasn't a press release. This entire video is going to be breaking down a super detailed Seeking Alpha article based on this interview with SoFi's Chief Financial Officer, conducted by Chris Hoeger, written by Chris Hoeger. Chris Hoeger also came on a Twitter Spaces earlier this week with myself and Riley, and he also broke down and paraphrased a lot of the key arguments, and I'll attach that Twitter Spaces in the link below, and I'll also attach the full Seeking Alpha article in the link below. This video is going to be paraphrasing a lot of the concepts. It's condensed and just boiling things down, definitely not going nearly into as much detail as the article is because this would end up being a 30-minute video. I'll break this out into sections, starting with, first of all, the context. So as I mentioned, Chris Hoeger reached out to SoFi's investor relations and then leveraged that to get onto a call directly with Chris Lapointe, the Chief Financial Officer of SoFi, and that turned into a 25-minute call. Stock-based compensation was one of the main things that was discussed. Now, this is important because stock-based compensation is one of the main pushbacks that often happens. You see it on Twitter all the time. Anthony Noto is harped as being one of the most highly paid executives. Bears argue that the executive team is diluting all the rest of the shareholders through stock-based compensation. And just as a primer, if you're not that familiar, stock-based compensation is bad for two reasons. Number one, it dilutes investors. The company is issuing more shares, and as the total number of shares outstanding rise, then the overall value of those shares is decreased for existing holders. And this makes sense since the shares are not purchased on the open market, but they are instead issued by the company. Number two, why SBC is bad is because it weighs on GAAP profitability. Stock-based compensation is a non-cash expense. It helps the company with cash burn because instead of paying somebody in cash, which would come out of the company's coffers, they essentially issue stock, which is a non-cash expense. But it still shows up as an expense and is deducted from the company's bottom line. Just to highlight how impactful this is, if we take a look at the latest quarter, third quarter of 2022, SoFi's net loss was $74 million, and their stock-based compensation was almost $78 million. In other words, if stock-based compensation was zero, SoFi would have, as of this latest quarter, been profitable already. So it is a big impact in terms of the accounting, even though it's a non-cash expense. But those are the two main reasons. So how stock-based compensation appears in SoFi is in two categories, which we'll break them down into chapters. Number one is restricted stock units, or RSUs, and the second one is performance stock units, or PSUs. Let's start with the restricted units. This is the majority of SoFi's stock-based compensation. These are granted and vest over time. Now, the fair value of the RSUs is taken at the day they're granted, and then they continue to vest over a certain period of time. The shares are then awarded at the stock price on the day of the award. So let's just do an example. You're an executive of SoFi. You're hired at the company. You get 100,000 shares on September 30th, 2021. The stock is trading for $15. The fair value is $15 multiplied by 100,000, which is $1.5 million in share terms. Now, these shares will vest over a total period of time. Let's just say for the sake of example that it's 1 year long. So you have 4 quarters where you divide that 1.5 million by 4 essentially, and this shows up in SoFi's financials accordingly every time that they report earnings. In other words, as the stock is awarded, it is expensed from the company's perspective. However, the value of the shares after this 1 year period where they vested can change. This is based on market value. So 1 year later, let's say, you still have 100,000 shares, but the stock is now trading for $5. So in essence, your 1.5 million became 500,000. However, the vesting period or the expense is the grant amount. So it's the 1.5 million. So from a company perspective, the expense would still be 1.5 million, even though the fair value for you as the executive is now 500,000 after this vesting period. So essentially, you as the executive would have received shares in this example that are worth 1/3 of the total cost that SoFi had to pay in GAAP net income for them. And of course, let's not forget about taxes. You as the executive would have to pay taxes on that amount as well. So essentially, for SoFi, it doesn't really matter because it's on the grant date, but for you, you lose or you gain value based on what happens during that vesting period. And generally with RSUs, there is a cliff period, basically a gap where your stocks do not start vesting until that period. This is generally a year. So for example, if I start a job on September 30th, 2021, I have to wait a full year until they start vesting on September 30th, 2022. And then from there on forward, you start that vesting period. Generally speaking, vesting periods are about 4 years. So it takes 4 years for you to earn out the full amount of stock that you were granted. And I'm saying generally here because this cliff period and vesting period is pretty standard across all companies. Generally speaking, it's 6 months to a year you don't start vesting, and then 4 years to 5 years to be fully vested so that you earn out all the shares. Now, SoFi is still giving a lot of restricted stock units. Chris explained this in depth in his article. He showed different charts showing outstanding RSUs that have been on an uptrend throughout this year. This, of course, is not good from a dilution perspective. However, from a stock-based compensation accounting perspective, the weighted average of the fair value of outstanding shares is decreasing. And this means that the total value of unrecognized stock-based compensation has risen, but not as much as the outstanding RSUs. Okay, so let's leave it there for RSUs. And again, for all of the details, please check out that article. I cannot stress that enough. It is the full detail. It is everything you need to know for stock-based compensation. All the links are in the description below. So essentially, RSUs, you have a date when they're granted and an amount when they're granted. You have a vesting period, and then you have a date when they're awarded and an amount that they're awarded. This reflects in the company's financial from a net income perspective. Great. Let's move on to performance stock units. Performance stock units are essentially the same as restricted, except they have another layer to them, which is that they are performance related. There has to be a target or an incentive met by that employee to unlock these shares. Now, a large amount of PSUs were granted to the team during the reverse merger, so IPOE to SoFi back in 2021. These are broken up into 3 categories or tranches, and they're only awarded when the stock price hits a volume-weighted 90-day trading average of these 3 buckets. The buckets are $25 a share, so 90 days trading average, $35 a share, and $45 a share. Now, this is fantastic news for investors since it now confirms that the team's objectives are aligned with the stock price increasing over time. Now, the article goes way more into detail as to how this is calculated, how these are expensed. Essentially, they use a simulation based on a number of inputs, but the important parts are that there's about 23 million PSUs for a total value of $220 million that need to be expensed. Now, one thing to note, by GAAP accounting standards, if the performance stock units expire worthless, in other words, they do not hit at least $25 by 2026, this $220 million that SoFi has to expense over a period of time, they still have to pay that. There's no recompensation for that. There's no thing you can claw back for that amount. Without going too much into the weeds, all 3 tranches will be completely expensed, reflecting in our financials by the first quarter of 2024. So I assume it is safe to say that we will see this $220 million reflect as an expense spread out from the financials from now until early 2024. And that's as it's expensed over time. Now, the good news is that performance stock units are no longer being issued. They were only like a one-time thing once the SPAC merger was completed and SoFi began trading with that ticker symbol. No performance stock units have been issued since the first quarter of 2022, and there's probably not going to be any going forward in the future. So we don't have to worry about them too much in the future as an expense onto our financials. Okay, I hope that wasn't too dense so far. We've understood what RSUs are, what PSUs are, and how they work in the context of SoFi. What does this look like going forward? Well, basically, stock-based compensation as a whole increased a lot after the company came public. However, revenue has started to go up, and stock-based compensation as a result has started to flatline over the past 12 months, hovering around 77 to 80 million per quarter. So as a percentage of revenue, they might have peaked at 27, 28% of total revenue, but that's now about 18% of revenue. And as revenue continues to increase, stock-based compensation is going to decrease. And especially because there will be no more performance stock units issued. So stock-based compensation is going to be lower in itself, and revenue is going to go up, so it's going to come down very, very quickly. As of right now, there's only about 72 million of unrecognized PSU compensation left. At the current rate, Chris Hoeger estimates that could be expensed maybe as early as mid-2023, earlier than the first quarter of 2024 that was expected. This is doubly good news, right? Because revenue is going to go up, stock-based compensation issued is going to go down, and as a percentage of revenue, that spread is just going to get crazier and crazier, to the point where stock-based compensation will no longer be a talking point by the bears to say that as a percentage of revenue it's too big because of these two factors going in opposite directions. Of course, when we talk about stock-based compensation, we also talk about dilution, right? How much incrementally are existing holders getting watered down as the company issues new shares? Chris noted that most investors don't know this, but there's actually a cap to the amount that SoFi can dilute shareholders through stock-based compensation. And that cap is a maximum of 5% per year annual dilution. The actual dilution, the article highlights, please go read it, it's super in-depth, is around 2.2% on an annualized rate for the RSUs. And don't forget that this amount is set to fall in 2023 and in 2024. As for the PSUs, the total dilution is about 2.5%, but that only happens once the actual tranches are hit. In other words, if SoFi hits $45, making it a 10-bagger from here, I'm fine with that dilution. And I think the vast majority of longs will be very fine with that as well. Performance stock units were not only given to executives, but they were given to the company at large, meaning that the entire company is directly incentivized with the exact same incentives that you as a retail investor have. They're motivated when the stock value hits these tranches, $25, $35, and $45 respectively. Now, each investor has to make their own decision. Basically, is it worth the squeeze? But in my opinion, it absolutely is, right? Because there's huge goals. We're looking at a 5 to 10x from current prices if these tranches are hit. And if they are, the executives are going to be incredibly wealthy, with Anthony Noto's personal before tax cumulative PSUs being upward of 289 million. Now, if the share price never hits $25 by mid-2026 and all of these performance units are worthless, the executives team's personal wealth is going to reflect in this, because a gigantic amount is tied up in the performance, meaning that they have a lot of skin in the game. And don't forget that this is the same for all of the employees at SoFi, since over 50% of the performance stock units were given to just regular employees, not even executives, right? So if the values are hit, everybody at SoFi is going to be very, very wealthy. If the values are not hit, it's the opposite scenario. And quite frankly, from a retail investor perspective, I think that that's proper incentive, right? If I'm looking at a 5 to 10 multiplication on whatever my stock amount is today, I'm okay with 2 to 3% dilution on my performance stock units. Of course, this is a big if, a big asterisk associated with can they execute. So just to conclude this video, some of the main takeaways from that article, from that Twitter Spaces, from the entire interview with the chief financial officer is, number one, well, the dilution argument is fully overblown because dilution is not as high as people initially thought. Number two, the performance stock units put management and employees' incentives directly aligned with retail investor incentives, basically the stock hitting a certain price by a certain date. Number three, stock-based compensation as a whole is going to come down, and it's especially going to come down as a percentage of revenue as the total revenue continues to increase for SoFi. And personally, I took this entire article to be extremely bullish. I took everything that Chris was saying in the Twitter space to be extremely bullish. In my opinion, I think this deconstructed single-handedly one of the biggest bear cases for SoFi, and it seems as the company keeps executing more and more, that more and more of these bear cases are one by one being broken down, which makes me, as a retail investor, as a long for SoFi, very, very bullish. And one last time in this video, please check out Chris Hoeger, who initially conducted this interview, who initially wrote that Seeking Alpha article, who also hopped on that Twitter Spaces, took time out of his day to just break it down for all of us. This video is just meant as a primer to spread awareness on that article. Please go visit it and read it more in depth in the description below. Chris also has a Twitter where he posts fantastic insights on SoFi. I'll also attach that in the description below. Thank you to Chris Lapointe, the CFO of SoFi, for actually hopping on that interview with a retail investor. I think that's fantastic. And again, like I said, this is by far the biggest SoFi news for this week, in my opinion, because it breaks down one of the biggest issues that bears have been harping on SoFi for years. So I don't know. I think you can sense the excitement in my voice. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.